Hello, welcome back. So in today's video, I'll be talking about something that all your best businesses, they have in common. So in today's video, I'll be covering a few things. We'll be covering the best business model for any single business, examples of these quality business, as well as some questions that you guys have left me in the comment section below. So let's talk about the best business model for any business first. So the biggest company in the world, all your Max 7 stocks, they have this one thing in common, which is your predictable stream of revenue. And this stream of revenue is recurring revenue. So when it comes to recurring revenue is highly predictable because any company with predictable recurring revenue allows them to survive any sort of economic environment. So in poor economic environments, they will still have customers buying from them and still paying them monthly subscription. So for these companies, they can survive any sort of poor economic conditions in the market. Besides that, recurring revenue also leads to less innovation risk. So when a company has recurring revenue, it is less reliant on new launches and innovation to attract even more income. The innovation risk is dangerous because once the company runs out of ideas or falls out of trend, that's when you see the earnings start to fall. Whereas for a recurring revenue, they don't have to go and chase for that because they have their existing clients paying them a monthly fee and a monthly subscription fee. So they'll have a very predictable stream of income as well. And then for a recurring revenue, it leads to pricing power as well because companies with recurring revenue, they will be able to have long-term relationships with their customers and they will experience less churn rates due to client relationships. This allows them to increase their prices at a modest rate above inflation as well. So it leads to operating leverage because when these companies have pricing power, they can increase their earnings at a faster rate as compared to the revenues. This is called margin expansion. So let's say a company sells their products at $100, but their cost is $50. Let's say in year 2, they increase their sale price to $110 and they hold the cost price at $50, which is what a lot of your different software companies have. And this company will be able to increase their profits at 20% while increasing their revenues by 10%. This is operating leverage. And normally for recurring revenue businesses, they'll be able to do it because the cost of the product itself, the cost of the product that they're selling will remain unchanged, whereas the pricing of the products will likely go up over time as they increase the prices of all these products. So an example of this company is Adobe. So for Adobe, they switched from a licensed business model to more of a subscription business model in 2013. And as you can see, before this circle portion over here, which was in 2013, their growth rate was modest. They grew at around 5% every single year. It was purely through volume growth. But after they switched to a subscription business model, not only were they able to increase their volumes over time, they were also able to increase their prices over time on the subscription, which led to even more growth for this company. So it accelerated their growth rate. And in this diagram here, it became a lot more steeper in terms of the growth after they swapped to a subscription model. So for Adobe, when they swapped from a licensed business model to a subscription business model, it led to higher lifetime value of the customer because if let's say a customer is able to pay $600 versus another customer that is able to pay $20 monthly recurring revenue, the $20 monthly recurring revenue will be worth a lot more over time. And on top of that, Adobe will also be able to increase prices on their initial $20 that the customer pays as well. So for your highly predictable businesses, recurring revenue is one of the elements that is important for the business. So this is what Chris Hohn said about recurring revenue. Let's see what he says about this one.
Reluctant to mess with it and switch because of the complexity.
How important are recurring revenue streams for you when you look at businesses?
It is important, but the predictability of when they recur is not. Okay, let me give you an example. So what's most important for us is something slightly different, which is essential product or service. We don't like things which are discretionary. Okay, so one space we've invested in for a long time is rating agencies. And here,
these are the people who basically give kind of character to different type of
they
bonds.
say, is it good or bad? Yeah. To people who invest in bonds, they say, is it investment grade, non-investment grade, give for research, and if you like, bless it. And there, you can actually defer. An issuer pays for the rating, but they don't have to refinance their bonds, which is a big part of it, in any given year. They can delay and defer, but eventually the debt has to be refinanced and rated. And so and so I think essential need is the the bigger point. But usually our companies have recurring and predictable revenue streams of essential products. And so
this is what Chris Hohn has said. Chris Hohn has said that predictability of recurring revenue doesn't matter so much. So as long as a company is able to have recurring revenue, when it receives the recurring revenue doesn't matter so much. Because if it receives it later, it will be able to hike up the prices for the customers. So the customers will have to come back and pay the higher prices, while this company was increasing their prices during the duration where it didn't receive the revenue from this customer. So as Chris Hohn said, for essential products, your predictability of your recurring revenue doesn't matter so much. So let's talk about some examples of companies with highly predictable income streams. So the first company is Amazon. Amazon is currently down 3% year to date, currently trading at a 34 times earnings. So for Amazon, they have their recurring revenue streams. They have their Amazon Prime subscription as well as the AWS portion. Both are recurring streams of revenue. So the Amazon Prime is $15 a month, and if you were to compare what they offer as compared to another company, which is Netflix, Netflix subscription is $17 a month for the one without the ads, and for Amazon Prime, it is $15 with free shipping, with Prime Video, with Amazon Music, with deals, as well as the Twitch subscription. So for Amazon, clearly their offerings are a lot more as compared to Netflix. I think the value for dollar that you're paying for the Amazon products is a lot higher as compared to the Netflix subscription alone. So for Amazon, this portion of the business is still a relatively low margin one, and they can easily double their prices over the years and people will still pay for it simply because of the value proposition that these products provide. So for Amazon, the other portion of their recurring revenue is the AWS portion. And over here, AWS operating margin has been increasing over the years. So it went from around 10% or so back in the years, and currently now is sitting at a 39% operating margin. This is operating leverage for the business. Basically, it's able to grow profits at much higher rates as compared to the revenue itself. So for Amazon, it's a quality business with a cash cow in AWS with a recurring revenue stream. So this is an example of a quality business with a recurring revenue business model. The next one are your rating agencies. As Chris Hohn highlighted earlier, it's your S&P Global as well as Moody's. So for your rating agencies, they are toll-gate businesses because the world runs on debt, and their credit rating businesses are essentially recurring revenue businesses. So they rate the debt once and then they are paid for monthly or yearly checks as well. So besides that, the debt issued globally will increase over time and companies will have to come back to refinance their debt. And when they refinance their debt, they have to get it rated again as well. And then you have bonds and debt that is maturing every single year on top of that. So for your credit rating agencies, they are incredibly asset-light and capital-light businesses. They can do zero reinvestment and just grow their revenues every single year by increasing their prices and by having secular growth trends in your credit market as well. So for these two businesses, they can make all of the profits and just return it to shareholders, which is what I love about these two credit rating businesses. The next category of your recurring revenue businesses are your installed-based companies. So the two that I would like to highlight now is Otis as well as ASML. So Otis and ASML, they have an installed base. Otis, they do the lifts. ASML, they have their lithography machines. And for your installed base businesses, your installed base growing leads to even more recurring revenue because companies will have to pay for maintenance and so on. Price increases leads to even more recurring revenue as well. So these businesses, they have almost 100% retention rate on their installed base business models because for ASML, for example, if they sell their lithography machines to a certain company, that certain company will have to get ASML personnel to be at the machines because the ASML personnel are the ones that are trained for these machines. Same thing for Otis. So besides that, there is also a high lifetime of their product. So ASML machines, they last up to 30 years. In fact, they last more than 30 years. Your Otis lifts, they last more than 20 years as well. So that leads to even more recurring revenue whenever there's wear and tear or whenever there are problems. And both ASML and Otis have that. So for Otis, around 60% of their revenues come from recurring revenue businesses. As for ASML, it's around 20% or so. ASML installed base portion will continually grow as more companies buy their lithography machines. So over time, these two businesses, they are highly predictable businesses with a stream of income that is highly predictable. The last category of businesses that have predictable stream of recurring revenue is your franchise businesses. So McDonald's over here, they operate under a franchise model now. So for McDonald's operating margin, McDonald's has incredible operating margin. So the operating margin for this business, for a restaurant business, is at 46%. So if you have to compare this to some of your software companies, it is almost comparable to them already. And McDonald's is a company that has physical restaurants as well. So for McDonald's and all your different franchise businesses like Domino's, they are capital light middleman businesses with annual franchise fees and profits on suppliers and goods. So for all these companies like McDonald's, Domino's, what they do is they will liaise with the suppliers. They'll get the products from the suppliers and they will sell it to all their franchisees. So they will make a profit on top of the goods that they get from the supplier. And besides that, they will also get a franchise fee as well as a percentage of the revenue that the franchisees make from the restaurant itself. So these are highly predictable, capital light, asset light businesses. And that is what McDonald's and Domino's have. And that's why you're seeing Warren Buffett investing into Domino's as well. And besides that, Domino's has incredibly high ROIC. It has a high ROIC of around 70% or so, even with the high debt as well. So I was quite shocked by McDonald's operating margin when I first looked at it. But these businesses, they are highly predictable in terms of the recurring revenue streams. Last portion, I'll be talking about some questions that you guys have left me in the comment section. So the first one, it says, hi, can you do a simple evaluation on Novo Nordisk? So for Novo Nordisk, it is a stock that is now around 50% from all-time highs. And for Novo Nordisk, they're facing intense competition as well, namely from Eli Lilly and their Zepbound drug. So the Zepbound drug is now bigger than the Wegovy drug that Novo Nordisk has as well. And for Novo Nordisk, the patents are expiring as well. So when your patents expire, it leads to price war and it leads to lowering of margins to gain larger market share. And this will kill their earnings over time. They are currently in the midst of lowering their prices already. And this is typically when you see companies start to fall off. And for CagriSema, the drug that they are pushing out right now has also a low efficacy as compared to your Eli Lilly drug. So when it comes to buying drugs, the two things to consider are number one, prices, number two, efficacy. So for your CagriSema, the efficacy is lower, and the only way for them to compete right now is to lower the prices as well. But lowering of prices will eat into their margins, and this will hurt their bottom line net income as well. So for Novo Nordisk, it's a company in a sector that is highly regulated. It's extremely difficult to understand the business model as well. And unless it drops to around a 15 times, 14 times earnings, where the downside is basically negligible, I don't think I'll ever be interested in this company. Next comment, it says, I'll be interested in your opinions on Futu Holdings. So for Futu Holdings, currently it's up around 33% year to date. The stock is now trading at a 17 times earnings. So what does Futu Holdings do? They own this platform called Moomoo. So Moomoo is quite big in Southeast Asia, and in Singapore is one of the largest brokers here. But for Moomoo, this is what I dislike about the business as well as their platform itself. They are trying the Robinhood business model, but they are turning Wall Street into a casino. So if you have to use the app itself, the interface is terrible as compared to other companies like IBKR as well as Weibo. So Moomoo is trying to model Robinhood and trying to bring in all the retail investors, and I hate that. And besides that, I also see better companies in China as well at better prices. So Alibaba is an example, and there are other companies as well which are extremely high quality in China as well, which I feel are much better opportunities as compared to Futu today. So for me, Futu is a company that I would avoid. Currently now we're in a bull market, and these brokerages, they are operating on leveraged earnings. So when you see a pullback in the stock market, these companies will likely have depressed earnings, and that is typically when you want to buy into these brokerages, not at the current state of the economy today. I hope you guys have found this one useful and invest safe.